So, you've decided to start investing. That's awesome. Seriously, making your money work for you is one of the smartest things you can do to build wealth for the long term. You see the headlines, you hear about people making a fortune on some new stock, and you think, I want a piece of that. It's an exciting feeling. Put a little money in today and watch it grow into a much larger amount tomorrow. But hold on for just a second. Before you smash the buy button on the first thing you see, we need to talk. Let's start with a big one, chasing hype. This happens when you hear everyone talking about a hot stock. It's all over social media. The price is shooting up like a rocket. You get a serious case of FOMO and think if you don't buy right now, you'll miss out. Often, by the time everyone's talking, the smart money has already come and gone. You're usually buying at the peak. When the hype dies down, the price crashes. To avoid this, do your own research. Don't buy just because it's popular. Look into the company's fundamentals. Invest in businesses you understand, not just popular tickers. Next, trying to time the market. It's the belief you can predict the lowest point to buy or the highest point to sell. Even pros can't do this consistently. The market is affected by millions of factors. Economic reports, global events, short-term moves are unpredictable. Guessing the perfect moment is more like gambling than investing. Instead, focus on time in the market. Time lets your money grow through compound interest. A practical tactic is dollar cost averaging. Invest a set amount regularly. For example, $100 every month. Over time, that averages your cost and lowers the risk of bad timing. It's a disciplined, less stressful approach that works over decades. Now let's talk about concentration risk. The third costly mistake is putting all your money into a single investment. Maybe you work there or you just love their products. You might be incredibly confident in one company. Anything can happen. Lawsuits, competitors, bad decisions. If all your money is tied up, a single piece of bad news can wipe you out. The solution is simple. Diversification. Don't put all your eggs in one basket. Spread money across industries and asset types. Beginners can get instant diversification with low-cost index funds and ETFs that hold hundreds or thousands of stocks. That's a much safer way to build wealth. Next, a quiet return killer, fees. The fourth mistake quietly eats away at your returns, ignoring fees. They might seem small, 1 or 2% per year, so beginners often overlook them. But small fees can massively hurt long-term growth. Over 30 years, a 1% annual fee can erase nearly a third of your returns. It's like running a race with a small weight on your ankle. Become a fee detective. Read the fine print before you invest. Index funds and ETFs usually have lower expense ratios than actively managed funds. Every dollar you save compounds for you. Look for low-cost options and commission-free trading so more of your money stays invested. The final mistake we'll cover is perhaps the most difficult: panic selling. When you see your portfolio drop, the temptation to sell everything to stop the bleeding can be overwhelming. The stock market does not go up in a straight line. There will be bad days, bad weeks, even bad years. It's natural. If you sell when things fall, you lock in losses, turning a paper loss into a permanent one. Have a long-term mindset. Remember why you started: to build wealth over many years, not get rich overnight. When the market goes down, try to see it as a sale. Quality companies may be available at a discount. Stick to your plan, continue to invest, and use automatic contributions even when it feels scary. So there you have it. 5 mistakes to avoid that can cost beginners a lot of money. If you're ready to start your journey toward financial freedom, hit that subscribe button and join me here on Freedom Through Investing. Let's build wealth and freedom together. This video is for educational purposes only and is not financial advice. Please do your own research before investing.